Ever wondered what really drives the numbers behind a company's performance? Beyond just the top-line figures. Welcome to the deep dive. We're your resource for cutting through the noise and getting straight to the insights that really matter.
And today we are diving deep into MSC Industrial Supply, specifically their fiscal third quarter 2025 earnings call. Our goal here is to, extract those key insights, find those aha moments. Think of it like a specialized analysis just for you.
Exactly. We want to unpack the results they reported, get into management strategic thinking, look at the bigger picture of the operating environment, and figure out what it all means for, where the company's heading.
Right. So we'll start with a quick look at the headlines, the main numbers. Then we'll really dig into the performance details and what they're doing strategically. After that, we'll zoom out a bit, look at the macro context, the outlook for the future, and we'll wrap it up with our This Is Not Financial Advice segment. Always fun.
Let's jump right in then. The headlines from MSC's Q3. So average daily sales, ADS, they reported it down 8% year over year. Now that sounds maybe a bit tough on the surface, but what caught my eye was the sequential improvement, up 7% quarter over quarter. That's actually better than their usual pattern, right?
Yeah, that sequential jump is definitely noteworthy. It suggests that, okay, the year over year is challenging maybe because of the market, but something they did within the quarter started working. And it wasn't just sales. Gross margins, they came in at 41%. That's the high end of what they expected. And they managed positive price cost, which is pretty good considering all the tariff noise and inflation.
Right. Managing margins even with those pressures.
Exactly. And the adjusted operating margin hit 9.0%. That's up 190 basis points from the previous quarter, right in the middle of their forecast.
Okay, so decent margin control despite the environment. And the bottom line.
Adjusted EPS came in at $1.18. Management, they framed these results as showing progress and an encouraging start for some new growth plans.
Okay, progress, encouraging. But let's get beyond the labels. What's really underneath this? What's allowing them to show this resilience?
Yeah, good question. It seems to tie back to these three core areas they've been hammering on all through fiscal 2025. They're focused on, one, re-energizing their core customer base. Mm-hmm. Two, keeping the momentum going in what they call high-touch solutions. And three, optimizing their cost structure, their cost to serve.
Okay, let's take that first one. Re-energizing the core customer. Sales there were down 8% year over year, same as the total company. But like you said about the overall numbers, this segment had the best sequential improvement. You mentioned initiatives gaining traction. Was it the web stuff?
I think that's a big part of it. They rolled out those web enhancements late in Q2, remember?
Yeah.
And they're seeing direct traffic to damsdirect.com grow low double digits year over year, mid-single digits quarter over quarter. Plus, importantly, site conversion rates are getting better.
So it's not just traffic, it's actual business converting online.
Exactly. Making it easier for those core customers to buy.
Yeah.
And they're backing it up with, better marketing and tweaking the sales force too. So it's a multi-pronged attack, really. Digital marketing, sales.
Makes sense. And pillar two, high-touch solutions. How's that looking?
Still strong. They expanded their footprint there. Implant programs, those are the on-site inventory things, up 23%. That's 399 sites now. And vending machines, they grew the installed base 9%, over 28,700 machines out there now.
Wow. And how much does that actually contribute?
Quite a bit, actually. It's becoming really material. ADS through vending was up about 8% year over year. That's roughly 19% of total sales. And sales to the implant customers, up 10% year over year, also about 19% of total sales.
So together, that's nearly 40% of their business coming from these integrated solutions.
Yeah, it's a huge chunk. These aren't just side projects anymore. They also mentioned some progress on the OEM product line too. Low single-digit ADS improvement there.
Okay, so deepening those relationships. Now the third pillar, optimizing costs and dealing with tariffs. What's the story there?
Well, they're making progress on network optimization. Still on track for that $10 to $15 million in annualized savings by fiscal 26. And they sound pretty confident about handling the tariffs. They just did another price increase, low single digits, broad-based. Interestingly, they're framing tariffs as like an opportunity to get closer to customers.
Is that confidence warranted, though, given all the uncertainty? Or are there risks they're maybe downplaying?
It's a fair point. Their confidence seems to come from a few things. One, the pricing power. Two, the cost savings. But also this made in USA push. That seems really key. Daily sales for those domestically sourced products are up year over year. And sequentially, they're doing better than the company average.
So it's not just dodging tariffs. It's a proactive strategy.
Exactly. It could be a real differentiator.
Yeah.
building supply chain resilience, appealing to customers who want domestic sourcing. It might give them an edge if competitors are more exposed globally.
That's fascinating. So it could be more than just a temporary fix, maybe a longer-term shift they're tapping into?
Could be. It speaks to agility, right?
Yeah.
And focusing on the customer when things get messy. Also related to strategy, they brought in a new CIO, John Reichelt. His job is to push forward on tech, more web improvements, supply chain tech, and getting that big digital core project moving again.
Okay, so investing in the tech infrastructure for the future, let's connect this to the wider picture now. What's the macro environment like for these guys?
Still pretty subdued, honestly, especially in manufacturing end markets. Automotive, fabricated metals still contracting according to the IP index, the industrial production data. Aerospace, though, that remains a bright spot, still growing.
And sentiment, how are customers feeling?
Well, the MBI readings, the Manufacturers Barometer Index, they dipped back into negative territory in April and May. Seems like customers are cautious, worried about tariffs, general uncertainty. MSC themselves saw a soft April, then things got a bit better in May and June. But yeah, customers are still hesitant about future production plans.
Okay, so headwinds are definitely still there, but you said MSSE outperformed the IP index?
Yeah, interestingly, their performance gap versus the overall IP index actually improved. They outperformed the index in 3 of their top 5 end markets, which kind of suggests their internal efforts, those pillars we talked about, are maybe helping them grab some share, even while the overall market is sluggish.
Right. Outperforming in a tough market is always a good sign. So looking ahead, what are they forecasting for Q4, the final quarter of their fiscal year?
Okay, preliminary June sales were trending roughly flat. For the full quarter Q4, they expect ADS to be somewhere between down 0.5% and up 1.5% year over year. That midpoint is basically flat compared to Q3. It includes some benefit from pricing, some lift from the initiatives, but balanced by, that caution around tariffs.
And profitability for Q4?
Adjusted operating margin, they're projecting 8.5% to 9%. Gross margins expected to hold up better than the usual seasonal dip, landing around 40.9%, give or take 20 basis points. And they see adjusted operating expenses coming down sequentially, maybe $2 to $4 million lower, mostly due to lower variable costs on slightly lower sales, some productivity gains, less spent on freight, partially offset by higher medical costs, though.
Gotcha. And any tweaks to the full year guidance for fiscal 25?
Yeah, a couple adjustments. Depreciation and amortization, now expected at the lower end of the $90-$95 million range. Same for CapEx, lower end of the $100-$110 million range.
Suggest maybe tight control on spending.
Yeah, prudent management. And the big one really is free cash flow conversion. Because cash generation has been strong, they now expect conversion around 120% for the full year. That's up significantly from the 100% they previously guided. That gives them a lot of financial flexibility.
Definitely. Okay, let's shift to some insights from the Q&A portion of the call. Pricing was obviously a hot topic. What's the plan beyond Q3?
Yeah, management stressed they need to be agile. That low single-digit price increase they just did will flow through Q4 and Q1 next year. But, full impact in Q4 is limited because some contracts lock in prices for a bit.
Okay.
They also mentioned seeing broader inflationary pressures now from suppliers globally, not just specific tariff stuff. So it's fluid.
Right. And the drivers for Q4 margins specifically?
They're expecting a pretty narrow gap between price increases and cost increases. Costs are catching up even as prices step up a bit. Customer mix is also a factor. If the public sector is strong, that's usually lower margin, so a bit of a headwind. But they do expect productivity gains to help offset some pressure.
Looking even further out, maybe fiscal 26 margins. Any early hints there?
Some cautious optimism. They talked about revenue stabilization, maybe gross margins helped by pricing discipline and getting a better mix of core customers back. And they expect OpEx growth to slow down after some heavy investment years. Those productivity savings, the $10-15 million plus more they're working on, should help. The goal seems to be getting back to a more typical incremental margin, like 20% over the business cycle, basically converting revenue growth to profit growth more efficiently.
And what about that core customer growth and the web strategy? Are those initiatives actually delivering results yet?
Seems like it. The marketing push is driving traffic and conversions, like we discussed. They're seeing progress with existing customers coming back and attracting new ones too. The long-term aim is pretty ambitious. Get core customer growth back in line with the company average and ultimately have the whole company growing like 400 basis points or more above the IP index.
Wow, that's aiming high. A lot of this seems tied to tech upgrades, that digital core project you mentioned.
Yeah, they're putting the foot back on the gas for that one. Upgrading their core systems, order to cash, procure to pay. It got slowed down, but now it's a priority again. They see it unlocking significant productivity gains in fiscal 26 and beyond. It's a foundational piece for efficiency.
Makes sense. And one last thing from the Q&A Salesforce efficiency. Any movement there?
Yep, early stages of a bigger program. Right now focused on coverage, basically redesigning sales territories based on customer potential, not just geography. Early signs are positive, things like more customer touches per rep, improving sales per rep per day. It all ties back to better engagement and cost optimization.
Okay, great insights. Now, before we get into our trade idea segment, the usual very important reminder, this is absolutely not financial advice. It's for discussion, illustration only. Always do your own homework.
Couldn't stress that enough. Okay, so playing the role of hedge fund analyst pitching to the committee. Considering MSSE's momentum with made-in-USA products, which seems fueled by their cost-cutting, plus that really strong free cash flow conversion, you can argue for a long position in MSSE. The bet is basically that their internal improvements and domestic sourcing strategy let them keep outperforming, even if the macro stays sluggish.
Okay, long MSSE based on self-help and domestic focus. How do you make that plausible? Maybe hedge it.
Right. To make it more of a relative value play, you could potentially pair it with a short position against a smaller industrial supplier. You'd look for one that's maybe less diversified, has more direct exposure to tariff risks, maybe hasn't really articulated a clear plan for mitigation or boosting domestic production. The thesis would be their margins might get squeezed, while MSSEs potentially expand or hold up better. Purely illustrative, of course.
A classic pair trade idea. Okay, let's recap the key takeaways from this deep dive. MSSE showed, I think, clear resilience, progress despite the macro challenges. Their strategic initiatives, especially web and high touch, are showing early positive signs. And there's a clear roadmap for more efficiency ahead.
And if you step back and think bigger picture, MSSE's focus on customer relationships through all this tariff stuff, plus the made in USA pivot, it does raise a question, doesn't it? In this kind of fragmented industrial market, with all the global trade uncertainty, could that deep customer engagement combined with supply chain agility actually be the ultimate competitive advantage? The real moat? Something to think about.
Definitely food for thought. Consider what stood out most to you from our discussion today. What does this mean for MSSE or even the broader industrial supply space?
And one last time, everything we've discussed here is for informational purposes. Please don't take it as investment advice. Do your own research. Talk to a professional.
Thanks for tuning in to this deep dive on MSSE Industrial Supply. We'll catch you on the next one.